If you were considering selling a property subject to the existing loan, or maybe you are an agent or some other professional looking to help a client consider a subject to offer, or if you are a buyer looking to buy and you want to help your seller understand the risk, let's talk through the risk for a seller when selling subject to. Now, when selling subject to the existing loan, there's a lot of moving parts here, but I want to dive into the risk so that everyone can be informed. When everyone is informed, look, I never want to rob someone of an informed decision. And understand this, informing someone of their decision does not automatically always say that people will just run and hide the other way. Like, I'm the type of person where I want to make sure everyone is on the same page and we understand and we're not hiding about talking about potential what ifs. And so, again, let's clear the air. Let's talk about these risks. There's 9 of them here. Stay with me here. So the first one is something called debt to income. So this is a financing term. So the fact that the seller is looking at selling subject to the existing loan, that loan would stay in their name tied to their credit. And so one of the biggest concerns in the risk is their debt to income. So what this means, and again, it's a financing term, is basically it may impact their ability to get another loan. Not may, it very well may. Uh, Especially one of the biggest questions I ask is if they're living in the house, what are their next plans? Because if you sell this house subject to the existing loan and you're staying in the house, are you going to go rent? Are you moving in with friends or family? Or you're looking to buy? Most people cannot immediately go and qualify for multiple loans at one time, meaning this loan is staying on their credit, but relative to their income, most people don't have enough income that they can have multiple mortgages tied to their debt. So, with that being said, for their debt to income, again, it impacts their ability to get a loan relative to their income. One of the biggest things here, again, I'm going to say, hey, what are your plans, especially if they're living in the house? And keep in mind here that if they are looking to buy, the two biggest things here are the timeline and the lender. We're going to talk about some other things here about financing, but that's going to be my next one. So I'm going to kind of save that for later. So the first one is that the timeline. So generally speaking, in a very general sense, I tell sellers it may take 2 years, up to 2 years, where basically I need to make 2 years worth of on-time payments. And then they can qualify in 75% of the debt of the mortgage is then removed from their debt to income with providing the paperwork that we did with the attorney at the closing, as well as proof of my monthly payments. And so there's a level there that the second part of that I said lender. The lender they choose is going to have to understand what happened. Not all lenders understand subject to deals because it is not as common in traditional of a transaction. So it's really important to understand this part. So the lender they use is important. So a lot of times I say, hey, I'm happy to give you some referrals and I'm happy to work with them, whoever that lender may be. Again, me referring one or referring a few is just going with someone who understands and is versed and understands subject to the nuances of it. So they're not just basically confused and, paralyzed from the confusion. So with that being said, one of the biggest things there is just debt to income. That's risk number one, right? It's this loan is staying on your credit. So if you're thinking about qualifying for a loan, think generally speaking on the higher end, it's going to be 2 years. Now, sometimes you can do less. A lot of that has to do with the type of loan product the seller is looking at getting, things like that. All right, that's risk number one. So risk number two is going to be similar. So the fact that the loan is staying in the seller's name and tied to their credit, especially. So this risk is going to be especially if it is a VA loan. VA loans are for veterans in the military, and these types of loans basically have something called entitlement. It's based on your state, and it's a number of which the VA entitlement they are entitled to, and that's what they can basically get VA loans with. And because this loan is not it's still tied to the seller's name. It is also still tied to their VA entitlement. If you are not working with the VA loan, you can skip this part, but this is important to know if you are. That entitlement is important that they understand that their entitlement will stay tied to this property and this loan for the life that this loan is still out there. Now, if me as a buyer, if I at any point pay off that loan, either through just paying it off, selling it, refinancing, whatever, okay, well, that changes the situation. Generally speaking, it should then go back. Their entitlement should be made whole at that point based off of that getting paid off. It's just important that they understand that that entitlement is held up and that this is not releasing their entitlement, especially if they're planning on using their entitlement to buy. Again, that veteran using a VA loan to buy does not mean they can't go and buy, for example, with another loan product. So that's all important for them to understand. This is a specific risk if you're dealing with a VA loan. The third risk here is if the seller is wanting to go and buy another house, and if they're wanting to use an FHA loan, but the loan that they're leaving, if they're selling this house and it has an FHA loan, the risk here that they need to understand is an FHA loan does have some limitations. Generally speaking, for the FHA loan, if they are selling a house subject to that has an FHA loan staying in place, but they're looking to buy again with an FHA loan, generally the restriction has to do with local proximity. So if that seller is buying really close, there may be a restriction there. So it's important, again, to deal with a lender who understands subject to deals so that again, they understand, can they go get an FHA loan? It's all important to understand because look, the offer to buy subject to may solve their problem today, but it's important to understand some of the ramifications that may happen, for example, in the next 6, 12, or 18 months down the line. All right, so those are the first three. The fourth risk. So a risk to selling subject to is that it's important to understand that there are credit concerns for all borrowers. Now, this could be a husband, wife. I have seen where there are co-borrowers, so someone who has co-signed on a loan, so that's important. I had one where a 38-year-old son had his dad co-sign on a property for him, and he got behind on his payments, and I bought that property subject to, and I was dealing with both the son and the father because both of their credits were tied to the property, and so they both had to be involved in the transaction. And so just keep in mind that all those parties have to be involved. Let's see. Number five. Number five is there's something called a due on sale clause. So in a loan, the due on sale clause is a risk because basically when a subject to happens, the title transfers from the seller to the new buyer. Okay. But the loan is staying in place. And so some people may say, Courtney, that's crazy. How can a house sell? So title is transferred, but the loan isn't being paid off. Can you do that? Well, in most mortgages, there is a clause. It's generally called an acceleration clause. The nickname within the industry is called the due on sale clause. And what it states is that in the event that the title should transfer, and the bank then has the right, but not the obligation, to then accelerate the remaining balance. Let's just say it's a 30-year loan, and let's just say there is 25 years left on the loan. Let's just say the balance is 200,000, just, for easy math. Well, even though there's 25 years left on this loan at the 200,000 is the remaining balance, if the lender sees that the title is transfers, they can then choose. Do they just keep accepting the payments and keep with the transaction as it sits? Or do they then want to accelerate the remaining 200,000, basically those 25 years left? They can choose to accelerate. They give themselves that out. They say they have the right, but not the obligation. So they can choose. And ultimately, they can then send a letter. What it looks like is they would send a letter saying, we've got 30 days to pay the remaining 200,000 in those 30 days. If you fail to do so, they can then start the foreclosure process. The reason why this is a risk to the seller is because in the event that this happens, it's important for them to remember that their credit is tied to this loan. Their obligation, is that in the event that this due on sale is triggered, then they can ultimately their credit is at risk for the pending foreclosure. So with that being said, the due on sale is important to understand. Now, I will state that it is rare for the due on sale to be called. That clause is in the mortgage, so it is there. So it is important for all parties to understand this. But at the end of the day, this is a rare occurrence for a lender to call it, they generally like receiving those payments, right? They would rather receive those payments than do this, but at the same time, rare does not mean never. There are instances where this has happened. Now, keep in mind, there are some solutions. For example, obviously, some solutions can be the buyer can pay the loan off, the buyer can refinance it, the buyer can sell the property before foreclosure happens. Those are some thoughts, right? There are also some potential reversals. These reversals can be to give the title back to the seller. Basically, oftentimes the borrower has the right to cure that default, right? So they could then put the title back in the seller's name. And then try structuring the deal another way. For example, like a lease option or in Louisiana, we call it bond for deed. Other states call it land contract, contract for deed. This is something that you could ask the lender if they would actually want to do that, if they would approve, if they would be open to that. With that being said, those reversals, although often talked about on the internet by many folks, are not guaranteed. It's a reminder here, folks, that these options here, again, are not guaranteed. And so the seller should understand the risk exists. Again, it is a clause in the mortgage. It's important for everyone in the transaction to know that it exists, but to keep in mind that it is not common that it happens, but the options surrounding in the event that it did happen. All right, so the next one, number 6. So the number 6 risk of selling a property subject to the existing loan is in the event that the buyer, who their arrangement is that they're going to make the payments on the loan on behalf of the seller, the 6 biggest risk, and this one here is the most common that people think of, is what if they don't pay, right? So a buyer default. And this is all going to be based on how the paperwork is set up in the front end. And so generally speaking, I recommend that you work with a title company or an attorney, whichever your state uses, that is familiar with subject to deals, and that the paperwork is done where it protects all parties involved. So this is, again, very important. It is going to be based on the paperwork. Now, the way that I do it in Louisiana is that we do the paperwork where the seller has protection, the buyer has protections as well. And that in the event that the buyer defaults, the seller's protections look like this: that in the event that the buyer doesn't make the payments, but let's just say the buyer is cooperative and they're willing to work with the seller and they're saying, hey, this deal is not going according to plan. I just, before this gets worse, I want to say, hey, I want to just give the property back to you. So any payments I've made, any improvements I've made, all of that you get to keep. Well, they can then do what's called a deed in lieu, where they give the property back to the original seller, the original borrower on the loan, right? And they can then give them back the title. The seller is now the title owner, and obviously the mortgage is there. So the seller can then, they can make up the payments. They can try to sell it before the foreclosure, anything like that. But the reality there is that's called a deed in lieu in the state of Louisiana. That is something that can be done, fairly quickly. Again, when all parties are cooperative, and can cost a few $100, depending on your attorney and all of that. Now, if the buyer is not cooperative, that's where it becomes more difficult. In the state of Louisiana, that would then, most based on the paperwork that I use, then the seller slash borrower would need to then foreclose. Our paperwork gives the seller um, the same teeth that the underlying bank has, in the sense that they can then foreclose on the property. Now, that is not the fastest. It will take a few months, and it could cost a few $1,000s. So that's really important. Again, that's generally when parties are not cooperative. But it is an option. It's important for the seller to keep that in mind, that those are risk, right? But that's also important, where the next one we're going to talk about here is that if you get behind on your payments, so risk number 7, if you get behind on your payments, some sellers, depending on their job, if you get behind on your payments, if you're facing foreclosure, if you ultimately get foreclosed on, or if you file bankruptcy, or if you have a short sale where basically you have to sell a property for less than what is owed, then some jobs, generally the ones where there's security clearances or financial dealing in the financial markets, that there is a risk to that job if you have financial issues. This is not all jobs. So if you were either a buyer who's working with sellers or a seller yourself or an agent working with sellers, it's important to know this one. This is the least talk about risk, but it's really important. I have even seen people who are in law enforcement, things like that, that it could impact their ability to get other jobs. So there could be some potential risk to a job, a source of income. If you have you're behind on your payments, if you are ultimately in foreclosure, facing foreclosure, file bankruptcy, things like that. So keep that in mind. Number 8, another risk is if you're saying, Courtney, selling on a subject to, these are risk for sellers. This is a risk, again, that people don't often talk about, but I want to put it out there, is number 8, if the buyer doesn't know how to handle a subject to correctly. So with a subject to transaction, there's a lot of moving parts, and it does take a level of sophistication to understand like how to navigate the insurance, how to navigate making the payments, how to navigate, for example, setting things up with the bank, things like that. All the paperwork, and just the overall, it's not simple financing. Of course, there was a level that it was simple for the seller to get that financing, and I say that relative to, they had to go through the bank's hoops to get that financing, but it's a little bit more common, right? It's common for people to work with a lender, qualify for a loan, and then just make payments on their mortgage. But when you're making payments on someone else's behalf, it is more sticky. There are moving parts. I say this all the time, that of all the types of financing I have as a real estate investor, subject to deals and subject to debt as an investor is my most complicated form of financing. And so, because of all the moving parts. And so, one of the risks is if a buyer says, ooh, I heard about this online and I want to just, immediately go and make an offer with this. But I don't really know how to do the moving parts, that is a risk to the seller. Because if the buyer doesn't know what they're doing, there is a potential that they could mess things up, they could default, things like that. So just it's an important thing to talk about. It's not sexy to talk about, especially as a real estate investor, and a lot of the people who listen here are real estate investors, but the reality here is this is a risk to the seller. And I never want to rob someone of an informed decision, and so I believe this is an important part to talk to be, well-rounded in this conversation. So that's also my ninth one. This is going to be one where it's the ninth risk I'm talking about today, and this is my final one again, is this is a risk to the seller. In the investing world, and investors, you guys are going to know what I'm talking about, is in the investing world is that there is a strategy, an investing strategy called wholesaling or assignments, where an investor would put a property under contract, and then they would then assign their position in that contract for a fee. So they're in essence making the fee to step out of the way. A different buyer steps into their position in that contract, and then they perform in their place on that contract. Very, very frequently, or maybe more widely known, this is done on a cash basis. I'll say this, but as of recently, this has become a lot more popular in the creative space. And in the recent years, this has become popular, especially with subject to deals and things like that, where folks will make offers to buy a property subject to. They tell the seller that, hey, I'll buy the house, I'll take over making the payments on your loan. But then their intention is to wholesale it. And so for real estate agents and sellers, they're looking at that buyer and they're saying, well, that's who's going to make the payments on the loan. And they may even do some due diligence on that buyer. They may call around, they may ask them questions about their history with subject twos, things like that. Because for the transaction to work, it's important that the buyer makes the payments on time, right? It's also important that the buyer knows what they're doing. And so it's important that the seller does some due diligence on the buyer. And so if that buyer the one that they're dealing with, is ultimately going to step out of the way and someone else is going to step into their place, there is major risk there for the seller because they don't know, number one, will they be introduced to that buyer? Number two, will that buyer know how to handle a subject to transaction, right? Will that buyer be able to handle, do they know the risk? Will they be able to handle making the payments regardless of performance of the property, right? And so those things are all really important here. A lot of folks, if you're new here, I am not a big fan of this in the industry. Wholesaling creative deals, I'm not a fan of it. And so, but this is a very clear risk for a seller. So if an investor's intentions are to wholesale it, that actually heightens the risk for the seller. Now, have there been subject to deals that have gone, according to plan and all parties are completely fine, intact, no damage done to them in the sense of the transaction and it's been assigned? I'm sure there are, right? Like there's a reality there that by talking through these risks, it does not negate that subject to deals have been done right and have been done well and have been done effectively where it's been a win-win-win for everyone involved. But it's important that everyone understands the risk. So these have been the 9 risks associated with selling a property subject to the existing loan. Now, obviously, this makes us feel all doom and gloom. So stay tuned. I'm going to do another video on the benefits, and then I'm going to make sure to come back and loop it in here on the end so that the end of the screen will have the choice to where you can actually click it, where I'm going to go over the benefits to a seller for selling on subject to. So appreciate you guys tuning in. I hope this was helpful for you. I like to be very well-rounded when I talk about these types of transactions. And so I'm curious if you are aware of any other risk. I'm also curious if you are aware of any, or if you have any questions about these types of risk as well. Let me know in the comments below. Appreciate you guys tuning in. As usual, I'll see you guys again tomorrow with another video.